The Canadian market dominated 2025. In the past year, the Canadian market outperformed the US, the S&P 500, by quite a bit. Does this mean that we can stick to the TSX and forget the rest? Absolutely not. That's a mistake. When we zoom out over the last 10 years, it's a different story. The US market beat the Canadian market 7 times out of 10. Just wait until you see the numbers, exactly how much the US outperformed in the past decade. This is exactly why I say I love Canadian stocks, but never go all in. Never put all your eggs in one basket. It's so important to be diversified geographically. That's what I do. As much as I invest in Canadian stocks, I invest an equal amount in the US market. But that means US dollars. And if you don't use the right brokerage, you'll waste a ton of money in conversion fees. Hey guys, it's Adrian here, the Canadian in a t-shirt. And here's why you should invest in the US economy. I'll break down the 2 main methods to access the US market for Canadians, and how I use Moomoo to save me a ton of money when doing so. Before we jump in, I want to give a huge thank you to Moomoo for sponsoring this video, and for offering an amazing sign-up bonus just for my viewers. Use my link below to lock in this bonus money. First of all, why should we care about the US market? Again, I love Canadian stocks and they've done very well, but Canada only makes up about 3% of the global economy based on GDP. So if you only invest in Canada, you're missing out on 97% of the world economy. Don't make that mistake. Don't get me wrong, Canada has some of the best companies and the best stocks out there. We definitely have quality, but what we don't have is diversification, at least compared to the States. The Canadian market is extremely concentrated in a handful of industries. Our economy is dominated by the financial sector, the big banks, and insurance companies. We're also dominated by energy and the materials sector, basically mining companies. Just taking those 3 sectors alone, that already makes up about 70% of Canada's economy, based on the TSX index. Again, those are great industries, and Canada has some of the best in the world, but it's just 3 sectors. It's way too narrow of a focus. You don't want to be so reliant on such a small subset. Let's look at what Canada is missing. The big one, of course, is tech. Most of the largest multi-trillion-dollar companies in the world are tech companies. Look at Microsoft, Apple, Nvidia, Google, Meta, Amazon. They're all American. In Canada, we used to have BlackBerry to lead the charge, but that's old news. Sure, we still have some great companies like Shopify, Constellation, OpenText, but it's a tiny fraction of the tech sector in the US. And the reality is that the tech sector has dominated for the past 2 decades. And with the ever-increasing demand for AI, this US tech dominance is not something I want to miss out on. I can't predict the future, but I'll quote some experts. According to PwC, they predict that by 2030, AI will add 15.7 trillion to the global GDP. That's 7 times larger than Canada's entire GDP, and the US is at the forefront of that wave. If you avoid the US market, you miss out on that growth. That's the future, but let's look at the past. In the past decade, since 2016, the S&P 500 has delivered a cumulative return of over 230%, while the Canadian market only gave us about 150%. Still great, but that's an 80% difference. If you invested $100K 10 years ago, the US investor would have an extra $80,000 compared to the Canadian. That's why I believe in diversification in every sense of the word. I'm invested across all industries and across countries. In my portfolio, I am equally invested in Canada and the US. This is an important point. I believe in supporting Canadian businesses and buying Canadian products whenever possible. When spending money, we should buy Canadian. That helps our economy. But for investing, buying a Canadian or US stock doesn't matter. Buying a stock does not mean you're supporting the company. If I buy TD stock, I'm not giving my money to TD. No, I'm buying those shares from someone else, another investor like me. TD is not getting that money. In fact, TD already got that money decades ago when they initially went public. Bottom line, diversify and make sure you have both Canadian and US companies in your portfolio. So, as a Canadian, how do you access the US market? Well, there are 2 ways. 1, stick to Canadian dollars with CDRs and Canadian ETFs, and 2, investing directly in USD. Let's start with option 1. You can buy a CDR, which is essentially a Canadian dollar hedged version of a US stock. Now for ETFs, you can buy a Canadian dollar version of a US ETF. For example, VOO tracks the S&P 500. It trades in USD. VFV is the same ETF, but it trades in Canadian dollars. On paper, that sounds great, and it's super convenient. Everything is in Canadian dollars, but here's the problem. You pay higher fees for that convenience. And worse, they're not one-time fees, they're annual fees. With CDRs, they charge an annual fee around 0.6%. That's pretty high, higher than most ETFs. And again, you pay this every year. Even worse, it's a percent-based fee. So as your portfolio grows, your cost also grows. Whereas if you bought the stock directly in US dollars, you only pay a one-time fee. Similar story for ETFs. All ETFs charge an annual management fee, but the Canadian dollar version of an ETF will always cost more than the underlying US fund. Always. Look at VOO in USD. It has rock bottom fees, only 0.03% per year, whereas VFV, the Canadian dollar version, charges 0.09% per year. That's literally 3 times the price every year for the exact same investment. And it's not just the management fees. You'll also get less volume and liquidity compared to the US versions. That means you might not be able to execute your trade, or you might end up paying a higher price than you expected. You also lose out on tax efficiency with the Canadian dollar version. If you hold a Canadian dollar ETF that contains US stocks like VFV, then there's no way to avoid the 15% withholding tax on those US dividends. Even in a TFSA or an RRSP, your dividends will always be cut by 15%. It's taken right at the source. Again, I look at this as an annual fee, a cost that grows every single year. Instead, if you held the USD version, such as VOO, and you hold it in an RRSP, now you can waive that 15% withholding tax. I have a whole video breaking down this important point right here. Take a look. This is the reason why the majority of my RSP portfolio is in US dollars. I get the tax benefit, no cut to my dividends, and I avoid those high annual fees. That brings us to option number 2, buying US stocks directly in USD. This is what I do. Yes, you have to convert your Canadian dollars into US dollars, but remember, this is a one-time fee, not an annual recurring fee. And if you use the right broker, you can save yourself a ton of money on those conversion fees. When I started investing a decade ago, we didn't have many options. All the banks were charging high fees, both for commissions and currency conversions. Now, we have many great options with lower fees, but many investors, especially beginners, still get hung up on the commission fees. They ignore the real cost. That's the conversion fees. They'll cost you a lot more, and with some brokers, they try to hide these fees from you. Don't save $2 on commissions only to spend $50 on conversion fees. It's so important to use the right brokerage, and that's why I use Moomoo. Let's see an example of the wrong brokerage. Something like Wealthsimple, which is very expensive when it comes to US investing. Be careful, guys. With Wealthsimple, every time you convert currency into USD, they'll charge you a 1.5% conversion fee. That's huge. But it's worse. On top of that, they also charge you an FX currency spread, and that's hidden. Basically, the exchange rate you see on Wealthsimple will always be worse than the actual exchange rate. In my experience, Wealthsimple charges around 0.4% on this spread. So in reality, whenever you buy a US stock, you'll be paying about 1.9% with Wealthsimple every time. Let's say you were buying $10,000 worth of Apple stock. Wealthsimple would cost you $190 just to convert into USD. That's a lot of money. Sure, you feel good. You saved a couple dollars on commission fees, but you paid $190 on conversion fees. Compare that with Moomoo. Moomoo doesn't charge you any conversion fees. 0. Even better, their FX spread is much smaller, only about 0.11%. That's it. That's all you pay. So if you wanted to convert $10,000 with Moomoo, it only costs you $11. $11 with Moomoo versus $190 with Wealthsimple. It's 17 times cheaper just by using the right brokerage for the job. And with Moomoo, this conversion is instant. You don't have to wait 3 days to convert your money like you would with Norbert's Gambit. I'm telling you guys, this is what got me into Moomoo in the first place. Their super low fees for US investing have saved me a ton of money already. I have a whole video where I break down and compare the fees across Moomoo, Wealthsimple, and Questrade. Check it out right here. Converting to USD is just the first step. Now we have to decide what to invest in. Again, this is where Moomoo shines. It's a one-stop shop when it comes to my research, analysis, and finding new stocks and ETFs to invest in. I'll show you a few cool things. Here in the Markets tab, I get a snapshot of the overall market. Click on the US tab and you'll see all the hottest stocks to look into. We see the top gainers, top losers, and a heat list. I love their visualizations. I'm looking at 10 charts all on the same page. This makes it so much easier to find my next opportunity. Talking about sector diversification before, check this out. Click on investment themes and you'll see custom lists based on whatever you're interested in. What stocks will benefit from quantum computing? Here you go. Or AI, or electric vehicles. They even have unique themes like Nancy Pelosi's portfolio or the great Warren Buffett. This helps me screen for new stocks that I've never heard of before. I love it, and it's all free. And if you're looking for ETFs instead, you get the same level of exploration. Featured lists, custom screeners, fund comparisons, and again, ETF themes. Here's all the ETFs that pay a monthly dividend or track the semiconductor industry. I'm just scratching the surface here. There are so many free research tools here, both for stocks and ETFs. Check out my past videos for an in-depth walkthrough of each. Whether you're a beginner or an active trader, stocks or ETFs, Moomoo has you covered and they'll save you a ton of money. So give Moomoo a shot and make sure you use my referral link below. I secured a fantastic bonus for you guys. Sign up and deposit $1,000 and you'll receive a $100 cash bonus. Even better, deposit $5,000 and you'll receive a $300 bonus. Plus, you don't pay any commission fees for 2 months. And whatever cash you have sitting in Moomoo will earn you 6% in interest. Click my link below and you'll see my customized landing page with Canadian in a t-shirt. That's how you know it's working. On top of the sign-up bonus, you can also get a transfer bonus. If you transfer at least $10,000 from your bank or brokerage, you'll receive an extra $300. Combining it all, this is one of the best sign-up bonuses I've seen. So use my link below and lock it in. Plus, you'll enter a chance to win a trip to New York. It's 3 days, 2 nights, all expenses paid. I've been there and it's really cool. There's a whole bunch of other prizes to win on top of the cash bonuses. Just be quick, the contest ends March 31st. Thanks for watching and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.